In today's video, I want to discuss 5 important points about price action trading that you must completely understand them. Number 1, context. Context is very important when you're analyzing the price chart. When you see a price action pattern, it may have different meaning and interpretation depending on where the pattern is forming. For example, when you see this candle on the chart, you cannot just interpret it without considering its location. For example, when this candle is forming in the bottom, like near a support level, it's considered bullish and it may give signals on advancing of the price. But if this candle is formed somewhere in the top, like near a resistance level, it's a bearish candle and it may give signals on declining of the price. Also, you must consider this fact that when an important news releases or a fundamental factor affects the market, they are reflected on the price chart and they show themselves in the form of price action, usually irregular movement. And so it causes some extreme moves in the price action before the market settles down. For example, on this chart here, you can see that because of a news or a fundamental factor, we had a sudden and sharp declining of the price, but then quickly the market settled down and came back to its normal movement. Or on this chart, you can see that the effect lasted longer, but then the market settled down and came back to its prior direction. So when you're analyzing the price chart, you must pay attention to the context and adapt to the current situation of the market, which brings us to point number 2, know hard rules and show flexibility, following the rule number 1, which was about context and adapting to the current condition of the market. Here we must show flexibility. When you're studying trading books or watching educational courses, you always see perfect price action patterns, but you must understand the fact that in reality they rarely happen in that perfect shape. The important point about the patterns that you must completely understand is that they show changes in buying and selling pressure. Actually, they show if the market participants are becoming more interested to buy or sell. In other words, price action patterns show that there are changes that are happening in the market sentiment, and you must perceive this from the patterns, not looking for perfect triangles or rectangles. All that matters here is the change that is happening in buying or selling pressure, not identifying perfect shapes on the chart. For example, here we have a double top pattern, but not in a perfect shape that you see in the books. All that matters here is that in this area we had rejection of the price, and this happened 2 times. So breaking of this level and having a reversal is very probable. Please pay attention that the market is the most dynamic entity and the price is constantly changing based on the forces of supply and demand. So expecting to have patterns in perfect shape like what you see in the books is far from reality, and professional traders never think about patterns like this. When it comes to price action analysis, all matters is to realize and understand how the market participants are acting. Their behavior and actions are reflected on the price chart in the form of price action. So the goal is to analyze the price action to identify changes in the behavior of buyers and sellers and responding to them in a proper way. Point number 3, confluence of levels. Confluence of levels on the chart provides you strong areas that can hold significantly. When you're analyzing the chart, always try to find confluence of levels because they show that the market participants have special attention to those areas. For example, on this chart, you can see that we have a strong support zone here. It was broken here, so now it becomes a resistance zone. On the other hand, we have this downtrend forming from here, with this zone acting as a resistance zone. So here in this area, we have 2 resistance zones, one from this area and the other from this area. When the price is around here, there is a high probability for declining of the price. So always try to find these kinds of confluent levels where you have 2 or more significant levels in action because they show very strong zone and they can provide you high probability trade with minimum amount of risk. Point number 4, you can't fight the market, so pay attention to the overall trend. When, for example, the market is trending up, I mean in long-term perspective, the market is in an uptrend. When you open a short position, it has higher risk of losing the trade in compared to taking a long position in the direction of the overall trend. When you open a long position in this situation, I mean when the overall trend is up, you have higher probability of achieving the expected result. That's why that experienced traders always analyze the chart charts also on higher time frames because they want to be sure that they are in the same direction with the overall trend of the market. For example, on this chart, we are on 4 hours time frame, and as you can see, the market is trending up. But when we switch to 1 hour time frame, you can see that the market is trending down. But this downtrend is just a pullback within the uptrend on 4 hours time frame. So always remember, when you're analyzing the chart, you must also do it on higher time frame so you can be sure that you're in the same direction with the overall trend of the market. Point number 5. You can't control the market, but you can control your losses. Without a proper risk management strategy, you'll be definitely out of the game. It's impossible to become a successful trader without a risk management strategy because you're not going to win every trade, and your losing trades will be out of the control, and a few losing trades are enough to wipe out all your profit or even your account altogether. The major element of every risk management strategy is setting a stop loss. Some traders use fixed percentages for setting stop loss, but the best technique is setting it based on price action. For example, when you open a long position, the best place for setting a stop loss is below the previous swing low because this is a support level and it's expected that the price will stop here and reverse. Or when you open a short position, the best place for setting a stop loss is above the previous swing high because this is a resistance level and it's expected that the price will stop at this level and reverse. Please pay attention when we talk about risk management. It's not only about setting stop loss, but profit target, risk to reward ratio, and the position size must also be included. There is a risk management strategy that is called 1% rule, and it's one of the most popular risk management strategy among traders. I have a complete guide on this. The link is also placed in the description, and I highly recommend you to watch it because without a proper risk management strategy, you'll be definitely out of the trading game. Alright, that's it. Thank you for watching this video. If you have any questions, feel free to ask and leave a comment for me. I'll answer your questions as soon as possible. If you haven't subscribed to my channel, please subscribe and hit the bell so you get the notifications of my new videos. See you guys in next video and good luck with your trading.